Good afternoon, everyone, and welcome to another edition of Tax Tuesday here at Molen and Associates. Whether this is your first time joining or you're part of one of the attendees that have been with us before, we're glad you're here. This is a series about turning complicated tax topics into simple, actionable strategies, because taxes shouldn't feel like a foreign language. Every Tuesday, we dig into real-world tax challenges. We break them down and we give you tools to make smarter decisions. So today's topic is one of the most powerful, often misunderstood. It's a tax strategy for business owners, how to handle purchases using Section 179 and bonus depreciation. With year-end quickly approaching, this conversation couldn't be more timely. I am Clark Boyd, part of the leadership team here at Molen Associates, and I'm excited to be joined by our very own tax manager, CPA, and depreciation enthusiast, Kathy Stump. Our goal today is to help you understand the why behind the deductions. Whether you're buying new equipment, upgrading technology, or thinking ahead to next year, this session's designed to give you more clarity, more confidence in your tax decisions. So let's get started. So a bit of an introduction into us. Molen Associates, our mission simple. We want to empower business owners, as I mentioned. We want you to be in control of your finances and understand how the tax code impacts you. So that's really our whole framework and premise for being in business. So with that being said, Kathy, I'm going to turn it over to you.
Awesome. Like Clark said, bonus depreciation and Section 179 are components of depreciation expense. Depreciation expense is how you take advantage of the deductions allocated to larger purchases. Even though some taxpayers can be cash basis taxpayers, which means they deduct expenses as they pay for them, the IRS kind of came in and said, well, no, you can't do that on larger purchases, larger pieces of equipment, real estate, any kind of commercial property like that. They want you to spread that out over the life of the asset and do a more like kind of match expense to your revenue stream. So that's the kind of the premise behind depreciation in general. Normally, just for a simplistic example, if you bought a piece of equipment for $100,000 and its useful life was 5 years and you were taking just straight line depreciation, you would take $20,000 every year of deduction against your income, not $100,000 in the year of purchase. So that's the basic way that depreciation works. But then the IRS did provide some incentives to businesses, some kind of help them to get the economy stimulated, and also to have a kind of a cash flow mechanism that makes it a little bit easier for businesses, especially in really equipment in commercial property type businesses that are heavy in expenses on those type of things up front. Section 179 has been around for a long time. It lets you take an immediate deduction for eligible business property. There are limits on it. They've changed over the years. There's a 2025 limit of $1.22 million. You can deduct that out of, just as long as you have income, you can deduct that. So if your property is $1 million and your income is $1 million, you can effectively make your income zero for that year. It cannot create a loss, however. So if you purchase something that's $1.2 million, you could take and had the same $1 million of revenue. You would take the $1 million, and then the rest of the $200,000 that you had left of that piece of property would be depreciated over its remaining useful life. The other change that happened with the Tax Cuts and Jobs Act was a concept called bonus depreciation. And it expanded Section 179 in a lot of ways. It has a kind of a broader base of things that you can deduct under bonus depreciation. And it also allows you to create a loss. If you are investing in your business and your revenue is just not quite to the point of being able to take all the deduction for a piece of equipment, but you need that piece of equipment to have your business continue and be successful. This is an incentive to allow you to do that. So in that same previous example, if you had $1 million in revenue and you need $1.2 million piece of property, you can purchase that and create a business loss. That business loss can be beneficial if it's a pass-through entity, that you would be able to take that against your current, other income that you have on your personal return if it's a pass-through. It does have limits on what it can and what you can do with bonus depreciation as well. Some vehicles qualify. They do have to be what they call heavy vehicles, like large SUVs, large commercial vehicles, like those sort of things that make you have, it's more likely that those really are business purposes, not small sedans and those sort of things. And there's no cap on bonus depreciation as well. You can, if you need $10 million of property in a year, you can have that a deduction available to you and not have to worry about your income limitations. The bonus depreciation also has no income restriction on it. You have, if you have, just as long as you're in business and it's a piece of property that's related to your business purpose, then you can deduct that piece of property. The important thing to consider with this as well is that there are timing considerations as well. This is an immediate expense deduction, but it's not any kind of workaround about being able to take that, against your basis information. If you've got a basis in your company that you are considering selling, this taking this depreciation up front does reduce your basis. And that can be a consideration when you're trying to sell your company down the road. This is also something that you need to consider. Careful timing is key in this. You need to look at it at the end of the year. If you're, it's not going to be beneficial to you to have a large loss in 1 year, and you know that maybe a larger income year is coming up the following year. That kind of strategy that you place in for the year-end tax planning to make sure that you're taking that in the year that it's going to give you the most benefit from cash flow, and also the most benefit from your taxable income, because that's where the kind of the cash flow comes from, is that you do have to pay for the piece of equipment, but if you're financing the piece of equipment, then the immediate benefit is being able to not have to pay taxes on that as well.
So Kathy, I'm going to pause you right there,
Okay.
just to make sure everyone understands, and really to clarify what you just said. So you're saying if I want to buy $1 million building, let's say the depreciable amount is $1 million, just for very, very simplistic math. If I finance it, I put $200,000 down, but the building is worth $1 million. I can depreciate, in this hypothetical, $1 million. So in theory, I could get more back in taxes than my down payment because it's accelerating that depreciation all in 1 year.
That is true. And that gives you that benefit of having that cash flow to do other things in your business, payroll costs, other expenses that you have to pay. To kind of get your business off the ground. It's also a convenient tool if you're considering expansion and need cash flow for those type of things. Or you have, key personnel that you need to hire, or those kind of things. It doesn't help you as much if your income is pretty much steady throughout the year, and throughout the year over year. If it's not steady, it's not as big of a benefit. And you have to keep in mind, too, that it is you will have, at some point down the road, you won't have as many deductions, and that tax burden can come back to you unless you have the type of business that just has continual need for continued investment in equipment. And software companies is a good example of this. If the software becomes obsolete very quickly, and you have to just keep spending and spending and spending on it, and it lets you have that benefit to have it, to be able to take it in the years that you purchase it. There needs to be also placed in service, and that's a common misconception, I think. Placed in service means, in the case of especially larger pieces of equipment, if you purchase them, they can't be in transit to you. You can't purchase them from a foreign entity and have shipping time involved if they're not going to be into your possession and also in your operation, that you actually have to be utilizing them in your business before they are effective in that year.
So to sum some of that up, it sounds like, as the example say at the bottom there, if you're going to be extra profitable, you can use Section 179 because you can't accelerate depreciation beyond what your profit level is. If you have a bigger income level next year, use regular depreciation. But if you're selling soon, you may not want to depreciate accelerated at all because of depreciation recapture.
Correct.
Okay.
And that's what I was talking about a little bit with the tax liability strategy. If you know that your example would be if you have a net operating loss from the previous year, and you know that even though you're in a taxable situation this year, that is going to wipe out your taxable income for the year, but you have a need for a piece of equipment, but that need is not urgent. You can postpone it to the next year. That's a good thing that they allow you to have that kind of flexibility of how you're going to be able to take the deductions for property that you might need in your business and that you need to purchase. Just always, I think it's really important, like the example says, it's a timing shift. It's not overall that you just get this money and it's free. You do get to have the benefit of the cash flow and the benefit of the reduced tax in the year. But if that piece of equipment is the only large purchase that you're going to have for several years, you just need to be aware of the fact that the next year there won't be any depreciation deduction. If you take it 100% in the current year, there won't be any depreciation next year for you to take, and that can put you into a higher taxable situation the following year. So it's just planning is key in this, and you just need to make sure that you understand the strategy to do your timing correctly. Banking and financing impacts, a lot of banks. I'm sorry?
Can I add one comment on that?
Sure.
But we say that it's a timing shift, not new savings. And that's true if you have fairly steady earnings. We've had clients where they'll make, let's say, $4 million in 1 year, and they think their normal earnings are about $2 million. So the more we can get them out of that $4 million taxable income down lower, that could be a very, very significant tax break for them to kind of even that out. So it could, if you are going from like a 37% tax bracket down to 24, that's a pretty significant tax savings to accelerate that depreciation. That isn't just timing shifting. That won't apply to everyone, but there are some cases where it by using this correctly, it could increase additional tax dollars or save tax dollars, let's say.
That is very true, especially kind of businesses that do have those kind of roller coaster revenue streams. Sometimes they don't really have control over that. In other ways, they really can't control the revenue. You know, obviously you don't want to turn down revenue. So a large revenue year, it gives you the capability to have larger deductions against that year and therefore reduce your tax rate in that year. So that really is a savings year over year. You just have to be aware of that strategy and plan for it. It's not something that you can say, oh, I'm going to do this at the end of the year. You probably needed to have been planning for that at least the last, several weeks of the year, making those plans to do your any purchases that you might need. And again, always keep in mind that you need to do the leave time in there if it's something that you have to order, something that you have installation time involved in, so that you can get it placed in service before the end of the year. And that's also another consideration with banking and financing impacts. Sometimes banks kind of look at that a little bit like, I'm not sure what's going on here. Why do you have so really high income in one year and then low income in another? and not really realizing the cyclical nature of your business. So it does kind of help in making sure that your reports that you're using and your reports that you're giving to the bank make sure that they don't kind of penalize you for using this legal tax strategy. The other thing is QBI income impact, and that is QBI is qualified business income, and applies to pass-through entities. Depreciation kind of works in the reverse on that a little bit, because it can reduce your income to the point that it makes you have a smaller QBI deduction. So that, again, is another reason planning is super important in this. These are kind of large numbers that you can be working with. You just want to make sure that you're considering all the things that it could impact, not just the immediate tax savings. Real estate professionals, rental income and cost segregation. These bonus depreciation in Section 179 can affect all of these sort of things. Bonus depreciation and Section 179 do not apply to real estate pieces of property like buildings, land, those sort of things. But cost segregation can step in and help you in those kind of situations. Rental real estate can be 29 years depreciation or 37 years depreciation based on your what kind of classification, whether it's residential or commercial. And that's a long time to spread your depreciation out. So what cost segregation does is come in and segregate out portions of that building or that piece of commercial property that can be depreciated under faster methods. You can break out equipment like air conditioning units, furnaces, garage door, like commercial garage doors, parking lots, things like that, that have a shorter time period, which is good, and it helps you in that kind of evening out and getting some more of the depreciation in the earlier years. But the biggest impact of that is that it does qualify then for bonus depreciation. So you don't just get to have it for the 15 years, which is still better than, you know, the longer term. But in this situation, bonus depreciation would apply, and you could take it all in the first year. The real estate professional classification is a classification of real estate operations type people. If most of your income is coming from real estate commissions, rental property, those kind of things, you can be subject to self-employment tax if you're not careful, which adds about 15% tax to your overall tax burden. If you are a real estate professional in the sense that that's your primary job, there are qualifications for it that you have to have more than 750 hours of service in rental property. More than 50% of your total personal services time, in other words, 50% of your work time, has to be in the real estate field. But if you do qualify for that, it allows you to have these be active participation pieces of property, which takes away the limits on passive income. It's no longer considered passive income. And like I said, cost segregation will move up that depreciation into those categories, 5, 7, 15-year property, but it also makes it be eligible for bonus depreciation.
So really, if you're not a real estate professional, you're still okay. You can still use these strategies. But if you happen to be a real estate professional, it can accelerate and let you use more of the depreciation. Just very, very simple terms.
Yes, definitely. OBBB, the One Big Beautiful Bill, that's where some of these things kind of came from with the bill that was passed in January. There are assets that they have all different kinds of dates associated with us. So that's another careful planning thing that you have to look at. If you purchase property from 1/1/25 to 1/19/25, you're under the old rules of bonus depreciation, because the old rules was phasing it down. They started out at 100%, went down to 80, 60. It was scheduled to be down to 40 for 2025, and then it was going to be gone. The bill placed it in back into 100% and back into a permanent situation, but the effective date of it is 1/19. So if you purchased anything in those first 19 days of the year, unfortunately, you're still at the 40% rate, not the 100% rate. You have the entity type differences, and that's where we talked about pass-throughs. S corporations, partnerships, sole proprietorships, those have personal tax impact on your personal return, because those types of entities do not pay income tax directly, but that flows through to your personal taxes. So putting that in there into the whole mix of things is another careful planning kind of strategy that you need to make sure that you're planning for that correctly, not just looking at just the business, but what your overall tax situation is going to be. If you have other passive income, if you have other W-2 earnings, other earnings that might push you into higher brackets, this is an effective strategy to be able to reduce that. C corporations are a little bit different. They do not qualify for QBI, but they also are not a pass-through. They pay their own income tax. So that's important for them, though, that they can take that bonus depreciation for the same purposes and the same process that other entities would. If they've got a year that they're having a large, especially a large unexpected income situation, and they think they're going to need property or equipment or vehicles anyway, then this is a good strategy for them to be able to reduce corporate income tax as well. Just kind of a recap of it, assets must be in use by 12/31, and that does mean they have to be in your possession and in service, which means they're operational and being able to be used. As in any tax situation or any kind of financial transaction, you always want to keep all your documentation, invoices, proof of the use, your depreciation schedule. And the sooner that you can contact your tax advisor and let your tax advisor know what you're considering, and make sure that you do qualify for all the things that you're considering doing with your tax planning, the easier and the better result that you'll have by giving them time to, just for example, if you're getting ready to purchase something and you're going to purchase it on 12/31, that might be a little bit too late to be able to get it into service for your year end to be able to take the full benefit.
And the nice thing about coordinating with your tax advisor early, like Kathy said, you can make sure you're following the rules. But there's so many. Let me see if it's on this next slide. There we go. This is perfect. There's so many. There's so many other strategies that correspond with this. For example, retirement contributions. If you take bonus depreciation and you bring your income, let's say from $100,000 down to $50,000, if you're a Schedule C filer, your SEP IRA, your basically your retirement contributions are 25% of your net profit. If your net profit goes down by half, your contribution also goes down by quite a bit. So you might not be able to put as much into retirement contributions through your business as you planned on. Charitable giving, there's different limits there. Medicare and IRMA, if you're those 2 years before retirement age and you're going to be planning on taking out retirement, those 2 years prior, there's an IRMA. Basically, it's a income-related Medicare adjustment. I can't remember exactly what it stands for, but if you want to use this strategically, you can bring down your income for a couple of years to lower that IRMA comparison. With another thing with the One Big Beautiful Bill, there's a $6,000 senior deduction. If your income is above that threshold, you just don't get the deduction. So this could be a great way to bring it down and qualify for the deduction. A really big one right now is SALT tax. Historically, we've been capped at $10,000 on a federal level. Now the cap is $40,000, but there's an income phase out If you go above a certain amount, it then faces back down to $10,000. So if you're right around, I believe it's 400,000, if you depreciate an extra $100,000 of assets, you can go from a $10,000 deduction to a $40,000 deduction on top of your bonus depreciation. So we're talking about a 50% tax difference if you're right in that sweet spot. So with all that being said, these types of calculations, this type of planning, it's helpful if we know your entire situation, not just, hey, I think this is a cool idea. Sure, you can do it, but there could be better ways to do it. Or you may be missing, oh, QBI. Maybe this depreciation now isn't worth minimizing the QBI. There is a sweet spot. It's not just planning for 1 year, it's really planning for your long-term strategy and the goal. So we want to optimize for your total financial picture, not just tax. Let's see if there's anything on here. Oh, a couple other things that Kathy's mentioned throughout this. Things that we need in order to help you. Basically, if you can forecast what your year-end 2025 income are, what purchases you plan on making, do you plan on putting down cash? Are you financing those products? We need to know, what are QBI estimates? What are your salary and retirement goals? When do you think you can place it in service? Keep the documentation, and also if you have any entity type strategies also in play. So obviously, if you're a client, hopefully we have a lot of these things for you. If you're not, this is kind of what we would need, or what you would need to do to execute these strategies. Anything else you would add here, Kathy?
I don't think so, other than just planning.
Awesome. Hey, we will open it up for Q&A. We try to keep these short and sweet. But with that being said, I'm sure there's lots of questions you guys have. So feel free to put them in the chat. Down on that toolbar, there's looks like a question mark and a speaker bubble. And I'll read them as they come through. Okay, our first question, and Kathy, I'll just read these, and feel free to answer them, or if it's too specific, we can answer it offline.
Okay.
For the first one, if I finance a piece of equipment, can I still take the full Section 179 or bonus depreciation this year?
It depends on your type of financing. If you're financing to purchase, and at the end of the financing arrangement, you will own the piece of equipment, then you can take the depreciation or the Section 179 or bonus depreciation on that property. If it's one of the kind of, they used to call them capital leases type things, where at the end you don't own it, then you wouldn't be able to. Leased cars are a good example. If you lease a car, you get to take the lease expense, but they get to take the depreciation and the tax credits and all of that.
Perfect. How does depreciation work if I buy a vehicle that I also use personally?
Well, the part of the depreciation that's deductible in your business is the business usage. So if you buy a vehicle that is only 25% used in your business and the rest of it is used for personal use, you can still take that 25% depreciation, but it would not qualify for bonus depreciation. Bonus depreciation has to be 50% or greater business usage to be able to qualify. And then you would still only, if you're using it 50% for business, you would only get to depreciate bonus depreciation for the 50%, not the full value.
Perfect, thank you. What happens if I take depreciation now and then sell the asset in a few years?
That's the term that we've been talking about, a depreciation recapture. Depreciation recapture is a little bit complicated, but basically when they let you take a depreciation deduction, you're taking that against your ordinary income. So they're going to reduce your capital gain. Just for rough numbers, example, say you've got a $10,000 gain on a piece of property. But you had $2,500 of depreciation that's already been taken on the property. Well, that $2,500 is taxed at your ordinary income rate, and then the remainder is all that would be taxed at the capital gain rate. So you do have to be a little bit careful about that. The other thing that's a compounding effect of that, if you're getting ready to sell your business and you do have a large amount of depreciation recapture, that can reduce the basis that you have in your business and increase the gain on your sale.
Thank you. I am considering going from a sole proprietor LLC to an S Corp. How do these rules apply differently for the two types of entities?
The bonus depreciation and Section 179 are similar in those type of situations. You would get to take for a sole proprietorship, you would take your whatever your bonus depreciation or your Section 179 would be. The same rules would apply for if you had income in those type of situations, that you would have you couldn't take more than the income for Section 179, but you could take into those situations into a loss for bonus. S corporations affect how you are taxed on your income as far as how it passes out to you. Schedule C is like sole proprietorship is 100% you, and it is 100% profit taxed or Social Security tax as well as income tax. Whereas S corporations, partnership, things that pass money or pass income through to you from an entity are taxed differently. And that what happens with that, they take the deduction, the S corporation or the partnership takes a deduction, and it just passes out less income to you. But then that income that passes out, especially from an S corporation, is not subject to self-employment tax.
Awesome, thank you. Okay, one last question. So I have a new business and I don't have a profit for this year. Can I carry Section 179 or bonus depreciation forward to next year when I do have a profit?
You can carry over net operating losses. It's not specifically, so the Section 179 would not carry over because it cannot create a loss. But the bonus depreciation can create a loss and would carry forward to your next year, where you might be able to absorb it depending on your taxable situation in the following year.
Perfect. Well, thank you. So just to wrap up, if you'd like to get in for a year-end planning, feel free to give us a call or email us right here. Our next webinar will be mid-November, so November 18th at noon. We'll be going over charitable giving. So a lot of times Christmas is the time to do that. Learn how to do it, some strategies around it to make the most of it on your tax situation. If you'd like to schedule a free discovery meeting. So if you're a new business, you haven't yet worked with us for our services, feel free to scan that QR code, and I'd love to meet with you and see if we're a good fit. But once again, thanks for joining our Tax Tuesday webinar. Have a great day.
Thank you. Have a nice day.